You know, the Forex market is the biggest financial playground on the entire planet. We're talking trillions of dollars flying around every single day. But have you ever stopped to wonder what's actually pulling the strings? What makes it all move? Well, in this explainer, we're going to pull back the curtain and look at the fundamental forces that drive it all. Let's dive in. So, yeah, this is the big question, right? And here's the thing. The market's movements aren't just random chaos. Nope. They're actually driven by a mix of its deep down structure, a whole lot of human psychology, and of course, real-world events. Getting a handle on these forces is the absolute key to making sense of any of it. Okay, to really understand how the market is built, we have to start with the most essential piece of the puzzle. It's the one thing that makes everything else possible, and that's liquidity. So what does that fancy word actually mean for you as a trader? Well, it means that because there are literally millions of people ready to buy or sell at any given moment, you can jump into a trade or jump out of one instantly. And you can do it at a fair price. You're never ever stuck on the sidelines waiting for someone to take the other side of your bet. Here's a great way to think about it. A liquid market is like a massive, multi-lane superhighway. The traffic is always flowing, and you can get on an exit ramp whenever you want, no problem. An illiquid market, that's more like a deserted country road at midnight. You might be waiting a very long time for another car, or in our case, another trader to show up. All right, so liquidity describes the market's structure, its skeleton, if you will. But what about its personality? Because just like a person, the market has moods, and trust me, you want to know how to read them. Is the market always calm and predictable? The short answer, no way, not even close. The market's mood can swing wildly, which brings us right to our next core idea, volatility. Now, this shows you the fundamental trade-off that every single trader has to deal with. High volatility, when prices are just jumping all over the place, that offers the chance for bigger wins, but it comes with way, way higher risk. Low volatility is steadier, it feels safer, but the potential for those huge gains is a lot smaller. It's that classic risk versus reward balancing act. So, if volatility is the market's mood, then what causes these intense mood swings? Well, they don't just happen out of nowhere. They're almost always a direct reaction to stuff happening in the real world. And we're talking about some major league stuff here. A central bank decides to tweak interest rates, that can send a currency soaring or tanking. A huge economic report comes out, like new job numbers, bam, you can see massive swings in just a few seconds. Even things like natural disasters or big political changes can send waves of volatility crashing through the market. Okay, so you've got this super liquid, often volatile market that's constantly getting hit with a tidal wave of global news. How on earth does anyone make sense of it all? Well, that's where analysis comes into play. Traders basically use two different lenses to try and bring some order to the chaos. Exactly. You just can't react to every little thing. To be successful, you need a disciplined way to filter out the important signals from all the background noise. And to do that, traders usually fall into one of two main camps, two schools of thought. This right here breaks down the two core philosophies. On one side, you have technical analysis. These folks believe that everything you need to know is already reflected in the price chart. They're like market historians, studying past patterns because they believe human psychology makes history repeat itself. Then, on the other side, you have fundamental analysis. These are the detectives. They're digging into economic reports, interest rates, political news, all the fundamentals, to figure out what a currency should be worth no matter what its price is right now. So how do traders actually get a jump on these big market-moving events? There's one tool that's absolutely essential, especially for those fundamental detectives, that helps them stay one step ahead. And this is it, the economic calendar. It's basically a schedule of every single major economic announcement on the horizon, from inflation reports to big speeches by central bankers. For a fundamental trader, this isn't just a calendar, it's a roadmap of potential explosions. It lets them see where the next big move might come from and get ready for it before it actually happens. And that brings us right back to the great debate. If you had to make a choice, would you follow the story being told by the patterns on the charts or the story that's unfolding in the daily news? The truth is, there's no single right answer. Every trader has to pick a path. So the real question is, which one makes the most sense to you?